Communication that we're getting from the Federal Reserve seems fairly clear and consistent to us. We believe they are telling us that they are incentivized to remove extreme levels of accommodation and attempt to cool higher prices in the United States. They are communicating to us that the United States is fairly close to maximum employment and US GDP growth will remain above trend. We think this environment is a very good economic backdrop, but we also think the Fed is giving themselves optionality to adjust the rate of potential rate increases should the economy change and should situations change. We think this is going to be akin to what we saw in 2018, where rate hikes only happened as long as the economic activity was strong enough in the United States to warrant it. We believe that sound central banking should benefit the United States because of their approach to remove accommodation when it is no longer warranted. That should give the United States the ability to ease when the economy needs it. At some point in the future, US economic activity will fall well below trend. Because of the tightening that's potentially happening this year, it will give the US Federal Reserve credibility to swiftly ease and adjust the demands of the next economic cycle. Interest rate risk should be front and center for all fixed income investors. Structurally, US short duration high income cushions the negative effect of interest rate risk. We have found that a lot of the debt that we had purchased in 2022 is becoming callable because companies took out a lot of debt in 2020 during the COVID-19 crisis to provide extra liquidity and make it to the end of the pandemic. This debt is now becoming callable in 2022. Companies are refinancing this debt with cash flow that they have generated from their businesses as economies have normalized and GDP in the United States has grown. We will reinvest these proceeds into potentially higher rates, providing better returns for our clients than strategies that are taking on interest rate risk and not having the ability of having principal repaid. We think a lot of companies have learned to carry better debt loads and more rational amounts of leverage. We think that's an enduring result of the pandemic that's really helping our strategies and our investments be healthier and less exposed to downside risk. On an individual company basis, we are paying special attention to companies that are able to pass through potentially higher prices to their customers and protecting their margins.